Hey everyone, welcome back to the Portfolio Pro, where we break down the world of investing so you can build wealth without the headaches. Imagine this. You're scrolling through social media, see a hot stock tip from some influencer promising 10x returns overnight. Your heart races, you dump your savings into it, and poof, it's gone. Sound familiar? That's the story of millions of new investors every year, losing fortunes not because the market hates them, but because they fell into traps that pros avoid like the plague. If you're new to investing, or even if you've dipped your toes in and felt the burn, this video is your wake-up call. Today, we're diving deep into the 12 most common mistakes new investors make, why they happen, real-world examples that'll make you cringe or nod in recognition, and actionable tips to dodge them. By the end, you'll be armed with knowledge that could save you thousands, or even turn you into a smarter investor overnight. And if you love practical advice like this, hit that subscribe button right now and turn on notifications. We drop videos every week on everything from stock picks to crypto strategies. Don't miss out. All right, let's jump in. Mistake number 1. Jumping in without a plan. Okay, mistake number 1. Diving headfirst into investing without a solid plan. Think of it like going on a road trip without a map or GPS. You might end up lost in the middle of nowhere, burning through gas, or, in this case, cash. New investors often get excited by the buzz. They hear about Tesla or Bitcoin skyrocketing and think, I need in now. So they open a brokerage account, buy whatever's trending, and hope for the best. But without a plan, you're gambling, not investing. Why is this a mistake? Markets are volatile. Without goals, like saving for retirement, a house down payment, or just growing wealth, you're reacting to every headline. Data from Vanguard shows that investors without a strategy underperform the market by up to 1.5% annually due to poor timing. Real example. Remember the GameStop frenzy in 2021? Thousands of newbies piled in without understanding the risks, chasing memes on Reddit. Many bought at the peak, $483 per share, and sold at a loss when it crashed to under $50. Heartbreaking. How to avoid it? Start with the basics. Define your goals, short-term or long-term. Risk tolerance, conservative or aggressive. Create a simple investment policy statement, a one-page doc outlining your strategy. For instance, allocate 60% to stocks, 30% to bonds, 10% to cash if you're moderate risk. Tools like free apps from Fidelity or Robinhood have goal-setting wizards. And diversify, don't put all eggs in one basket. Pro tip, review your plan quarterly, not daily, to avoid emotional tweaks. If this is hitting home, smash that like button. It helps the algorithm spread this wisdom to more newbies like you. Mistake number 2. Ignoring diversification. Moving on to mistake 2. Putting all your money into one or two sure things. This is the classic eggs in one basket blunder, and it's a killer for new investors. Why do we do it? Excitement. You fall in love with a stock like Apple because it's shiny and familiar, or crypto because your friend made bank on Dogecoin. But if that one asset tanks, so does your portfolio. The stats are brutal. According to a Morningstar study, undiversified portfolios lose an average of 20 to 30% more during downturns than balanced ones. Diversification spreads risk. When one sector dips, another might rise. Case in point, Enron scandal in 2001. Employees invested heavily in company stock, thinking it was invincible. When it collapsed from $90 to pennies, retirement savings vanished overnight. Fast forward to today. Many new crypto investors in 2022 lost 70% plus by going all in on NFTs or altcoins during the bear market. Avoidance strategy. Aim for a mix. Use ETFs like VTI, Total Stock Market, for broad exposure. It's like buying the whole haystack instead of hunting needles. Allocate across assets, stocks, bonds, real estate, maybe 5 to 10% in alternatives like gold. Rule of thumb: no single stock should exceed 5% of your portfolio. For beginners, index funds are gold. They track the S&P 500 and historically return 7 to 10% annually after inflation. Start small. If you have $5,000, split it. $2,000 in stocks, $2,000 in bonds, $1,000 in international funds. Apps like Wealthfront automate this with robo-advisors. Diversification isn't sexy, but it's what turns gamblers into millionaires over time. Mistake number 3. Chasing hot tips and trends. All right, mistake 3. Falling for hot tips from friends, social media, or gurus. This is the FOMO trap, fear of missing out, and it's everywhere. Newbies hear this stock is the next Amazon and rush in without vetting. But tips are often biased or outdated. Remember, if it's public knowledge, the market's already priced it in. Research from Dalbar shows that investors chasing trends underperform by 4 to 5% yearly due to buying high and selling low. Exhibit A, the meme stock craze with AMC in 2021. Influencers hyped it to $72. New investors bought in droves, then it plummeted to $5. Losses galore because it was hype, not fundamentals. Or TikTok crypto pumps. People bought into obscure coins like Shiba Inu at peaks, only to see 90% wipes. How to steer clear? Do your homework. Use sites like Yahoo Finance or Seeking Alpha for data, not opinions. Ask, what's the company's revenue? Competition, P/E ratio under 20, is often reasonable for growth stocks. Build a watch list of 10 to 20 stocks based on your research, not trends. Follow Warren Buffett. Be fearful when others are greedy. If a tip sounds too good, wait 48 hours. Impulse fades. And subscribe to channels like ours for vetted insights, not hype. Speaking of which, if you're not subscribed yet, do it now. We debunk trends weekly. Mistake number 4, emotional investing. Mistake 4, letting emotions drive decisions. Greed pushes you to buy during booms. Fear makes you sell in crashes. It's human, but deadly for returns. Psychologically, we're wired for loss aversion. We feel losses twice as much as gains, per behavioral finance studies. This leads to panic selling, missing rebounds. Numbers don't lie. JP Morgan data reveals the average investor earns just 3.6% annually versus the S&P's 10% because of emotional timing. Real-world horror. 2008 financial crisis. New investors sold stocks at the bottom, locking in 50% losses, then missed the bull run that followed, turning $10,000 into $50,000 by 2018 for those who held. 2020 COVID crash? Same story. Markets dropped 34%. Panickers sold. Holders saw 100% plus gains by 2021. Fix it. Adopt a rules-based approach. Set stop-loss orders, e.g., sell if down 10%, but pair with buy rules. Use dollar-cost averaging. Invest fixed amounts monthly, regardless of price. Buys more shares when low. Journal your trades. Why buy? Why sell? Review emotions. Apps like Betterment use algorithms to remove bias. Mantra: invest like a robot. Data over drama. Over time, this compounds massively. Mistake number 5. Overtrading. Next up, mistake 5. Overtrading. Buying and selling too frequently. racking up fees and taxes while chasing quick wins. New investors treat the market like a casino, trading daily on news. But each trade costs commissions, even if free, spreads add up, and short-term capital gains taxes, up to 37% versus 15% long-term. Fidelity studies show frequent traders underperform buy and hold by 1.5 to 2% yearly. Example: day traders in the Robinhood boom. Many lost 80% plus in 2020 to 2022 due to constant churning per SEC reports. Avoid buy, going long-term. Hold investments at least a year for tax benefits. Limit trades to 4 to 6 per year unless you're a pro. Use low-cost index funds, set it and forget it. Track portfolio weekly, not hourly, to curb impulses. Pro tip: if bored, educate instead. Read The Intelligent Investor by Benjamin Graham. We're halfway through these eye-opening mistakes, and if you're learning a ton, pause and subscribe now. Ring the bell for notifications. We've got more videos on avoiding pitfalls and building portfolios coming up. Your future self will thank you. Mistake number 6. Investing money you can't afford to lose. Mistake 6. Using emergency funds or borrowed money for investments. This is high-stakes poker with your safety net. Beginners think, I'll double it quick. But markets can drop 20 to 50% anytime. If you need that cash for rent or bills, you're forced to sell at a loss. AAII surveys show 40% of new investors dip into essentials, leading to stress and poor decisions. Case: margin trading disasters in 2022 crypto winter. People borrowed against assets, got margin called when values halved, losing everything. Solution: build an emergency fund first. 3 to 6 months expenses in a high-yield savings account. 4 to 5% APY now. Only invest disposable income. Rule: if losing it keeps you up at night, don't invest it. Start small, 100 per month via apps like Acorns. This keeps investing fun, not frightening. Mistake number 7. Neglecting fees and expenses. 7th mistake: ignoring the sneaky fees that eat your returns. Commissions, expense ratios, advisor fees, they add up like death by 1,000 cuts. Newbies pick funds with high fees, 1 to 2% thinking performance justifies it. But Vanguard data: low-fee funds, 0.1%, outperform high-fee by 1% plus yearly, compounding to millions over decades. Example: mutual funds versus ETFs. A 1% fee on $100,000 costs $1,000 per year. Over 30 years at 7% return, that's $300,000 lost. Crypto exchanges: hidden spreads and withdrawal fees can take 2 to 5%. Dodge it. Choose low-cost brokers like Vanguard or Schwab. Opt for index ETFs, expense ratios under 0.05%. Calculate total cost. Use FINRA's Fund Analyzer tool. Tax fees too. Use Roth IRAs for tax-free growth. Small savings here equals big wins long-term. Mistake number 8. Focusing only on short-term gains. Mistake 8. Obsessing over quick profits instead of long-term growth. Day trading dreams lure newbies, but reality bites. Short-term focus leads to high taxes and missed compounding. Historical data: S&P 500 averages 10% yearly long-term, but daily volatility is wild. Story: lottery-like wins in options trading. Most lose 90% within months, per CBOE stats. Fix: think decades. Compound interest: $5,000 invested at 7% grows to $76,000 in 40 years. Set long-term goals. Ignore daily noise. Use apps with projection calculators. Patience pays, literally. Mistake number 9. Not understanding risk. Ninth, underestimating risks. New investors see upside but ignore downsides like market crashes, inflation, or company bankruptcies. Risk ignorance leads to overexposure. Beta measures volatility. High beta stocks swing wildly. Example: Tech Bubble 2000. Dot-com darlings crashed 80%, wiping out naive portfolios. Assess. Take quizzes on sites like Morningstar for risk tolerance. Balance with bonds, lower risk. Use VAR, value at risk, basics. What's the worst 5% scenario? Knowledge equals confidence. Mistake number 10. Skipping continuous education. Mistake 10. Thinking one book or course is enough. Markets evolve. AI, ESG, geopolitics change everything. Stagnant knowledge equals outdated strategies. CFA Institute. Lifelong learners outperform by 2 to 3%. Example: ignoring inflation in 2022 led to bond losses. Commit. Read weekly. WSJ, Investopedia. Follow podcasts like Planet Money. Join communities, but verify info. Education is your edge. Visual, books stacking, learning timeline. Mistake number 11. Poor tax planning. 11. Overlooking taxes. Capital gains, dividends. They bite if unplanned. Short-term trades tax at income rates, up to 37%. Long-term, 0 to 20%. Mistake: not using tax-advantaged accounts like 401ks. Example: selling winners yearly triggers taxes, reducing reinvestment. Plan: harvest losses to offset gains. Max retirement contributions. Tools: TurboTax simulations. Taxes managed equals more money kept. Mistake number 12. Giving up too soon. Final mistake: quitting after first losses. Investing is marathon, not sprint. Newbies bail after dips, missing recoveries. History: markets always rebound. Example: post-2008. Quitters missed 300% plus gains. Persist. Learn from setbacks. Adjust. Don't abandon. Mindset: view losses as tuition. You're in for the long haul. Ooh, we've covered the 12 biggest pitfalls new investors face, from no-plan chaos to emotional roller coasters and beyond. Remember, everyone starts somewhere, but avoiding these can accelerate your path to financial freedom. Key takeaway: invest with a plan, diversify, stay educated, and think long-term. Start small. Learn big. If this video saved you from a costly mistake, like and comment below. What's your biggest investing fear? Share so we can tackle it in future vids. And most importantly, subscribe to the Portfolio Pro right now. We deliver no-nonsense advice on stocks, crypto, real estate, and more every week. Hit the bell, join the community, and let's build wealth together. Thanks for watching. See you in the next one.